Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes. So we look at Palantir, and PLTR is the symbol. And what's funny is it was really hard based off of the chart and just a few other things in the marketplace to try to determine which way we want to go. It's obviously overvalued. Well, fundamentally, the numbers don't look that great. We trade at an insane PE ratio overall. Very, very much so a news-driven stock in this day and age with Palantir Technologies. And here's where we were hanging, right on the cusp, right near this all-time high. And once again, it gets interesting if the marketplace, I meant to type in 1,000 days. Let's do 1,000. There we go. If the marketplace were to, if after their earnings announcement, if the market would have broke through to the upside, definitely would have been a buy signal in Palantir. Now, we came down quite a bit. It actually was the expected move right after earnings, right about $17. And I did say that if there was one trade, I wouldn't have wanted to do it, but the one trade that is very interesting was to just buy the long straddle, buy the $17 straddle. The market was at 124 and now we're trading at 109, so we're down 15. At the day of, we did go all the way down to 106, so we're gonna go another 4 points. Yeah, so that's about 19 points. So it did what the marketplace was anticipating. The expected move was about, or the actual move of the stock matched the expected move based off buying the at the money straddle. So you wouldn't have killed it by doing the straddle, even though you got that type of move. You really do need it to move more because implied volatilities come out. What you gain on the put in this instance, you're going to lose on the call. So if for example, if the call goes to zero, the put's got to trade for 17 or more. If you paid for the long straddle and you paid 17. So that trade, there would have been opportunities to make money on it, but it was a lot of risk and you would have made $1 or $2. Now, we made the official paper trade on the upside. And once again, there's the earnings catalysts. You go to the upside, you're looking real strong. On the downside, now we have the 20-day, the 50-day, and the 200-day. All of this is in play. I think the path of least resistance is to the downside, down right around the 100 level. That's where you could see it drifting off to before you see a little bit of resistance in the underlying stock. So I'm going to look at another trade in Palantir, mainly because there is, I do feel like there is downside potential in the stock. We break below that level, then we get a little bit scary. So it's quite simply after earnings, you could either buy a put outright, or we can just try to target a shorter term move all the way down to that 100 level. Because right now, as far as the chart is concerned, you're kind of in no man's land. Now, if it breaks below 100, but that means that you move down below the 20-day, and now you're in this flux between the 20-day moving average and the 50-day moving average, and you have this huge gap over here, and the stock is really doesn't like to stay in that range, right? Look at how wide the moves are within this area. Now, with that said, obviously a lot of news headlines, and the markets just in general have been extremely busy. So I decided if I'll look at the two trades that we put out. We said if you want to get bearish, you could flip a coin on Palantir, and if you wanted to get bearish, we put together a open wing put butterfly, and then we also went out and put together a open wing call butterfly. So the fact that it didn't blow it out of the water, the put butterfly, I just want to look at it because it's interesting, even though ideally we did the call side of things, but we did manage our risk. We only spent a couple of $100 when an at the money option contract was trading for $7 or $8, right? So we managed our risk by doing the butterfly, even lowered it compared to just doing a call, a bull call spread, where we're just buying one option contract and selling one option contract. That would have cost us more. So I'm going to go over to the what if calculator. And inside the what if calculator, I'll show you the long put butterfly. This is the screen grab from when it was all put together on the long put, or it's not the screen grab, but this is where the market was at 125 when we put this on. Now that's where a 1 standard deviation move is at. And we had substantial upside all the way up to the 135 level. And then if it went beyond that all the way up, we still had a real good chance at a solid profitability. These option contracts are now trading for basically nothing. I think I have the right one here. This is the long call butterfly, right? So it's trading for 10 cents. You could sell it and get out if you wanted to. You could, this one option contract has a 10-cent in it. You could try to play a little game with it or not, but I would just close it. The stock's not going to come back. It's not going to come back, break through that level and just go to the upside today. That isn't going to happen. You have until the end of the week. So try to salvage it, get your 10 cents and move on and say you were wrong. Now on the put side of things, though, it does get a lot more interesting. So market's at 109. We're within the wings now. So this is just we're talking about implied volatility was like, well, I think it was 160, right? It was double. Yeah, 150, I guess, is where the implied vol is at. We're still at 80. I think it was about double what it is now. So we had that trade on. Go back to the what if calculator. Implied volatility has came off. We're trading within this range. The maximum that it could trade for on this side is the difference between the strikes. So 10 points is the maximum it could trade from 122 down to 112. That's the maximum that it would be worth. And then we opened the wing. This is shorter. This is only 5 points, allowing us to make 5 points if the market goes down this direction. Now realize, dang it. Now realize this is as of today. I'm going to take a pause and take a drink. All right. So now let's send this to the trade ticket. And we see that this is now trading for about $6. So we put it on, we paid $2.50 for it, $2.50. And I do remember we had trouble getting it on because there was so much that was going on. The maximum that it could trade for is 10, and now it's trading for 6. We're leaning on this side of things, which with the open wing butterfly is fine, because if it continues on down, you will still be profitable. So like if I had 2 of these on, I would close one today, let the other one ride until Friday the 9th. If you just have one on, well, then you got a tougher situation. I don't mind letting it ride because a day or 2 of time decay on option contracts that are still trading at 80% implied volatility is going to be large, and it's going to reward you. You got the risk of it going down. You might give up something, but if it ever comes up to the 112 level, you just get out. You close it. You don't let it meander this way and give yourself a loss. So I would put a limit. I would put an alert in at 112. And if it hits that, I would close it at the midpoint and just try to get out at any point in time. But I would let this thing meander for a couple of days. As long as it doesn't break this way to the upside, I'd let that trade ride if I had that position on. So interesting trade. We did get a 15-point move to the downside, and we put a trade on for $2.50. We could make $6 on it right now. We could sell it. So 250 cents worth of risk, got a muted move to the downside, and now you could get out of the trade for $6. I like these butterflies around earnings on high volatile stocks. All right. Any questions on that trade? Oh, there we go. Got something. Your put butterfly is now trading for 610. Okay, I wrote it down for 605. There it is, right there. I put it on for 650. Yeah, Anthony, did you do the call side? I was leaning that it was going to break out to the upside on the call side of things, because earnings haven't been bad. Forecasting has been bad. And a lot of companies just stopped forecasting, like Ford, no longer giving any guidance going forward. But the put side was the right side. All right. So now I still want to be bearish on it. Let's get bearish on it. I was playing around before the show. I was looking at a couple of other options as far as just looking at butterflies, and I'm not that excited about those trades. So I'm going to switch this up. This was the May 16th scenario. And what I would just do in Palantir right now is, because you're going to get so much premium down here. Where's the chart level? It's right at 100, right? That's where the stopping point is. This is where we think we're going to have a tough time breaking through. And if we do, we really want to get bearish. So we're going to go a little bit out of the money, and like we can still sell this. Look at the implied vol. We're getting 70. Look at the difference in the skew. And this is why a long put butterfly, or I'm sorry, a long put spread is interesting, in that there's still a lot of skew to the downside in Palantir. If you can see this, the implied volatility on the at the money is at 66. You go down to 100, it's at 72. That's a big number. That's a big difference. You're getting a lot of pumped up volatility at the 100 level here. So we want to sell that, and we can get into this long put spread at a decent price because of the ginormous implied volatility skew. And you know what? I'll highlight that. Let's put this trade in, and we're going to say, because I think I'm okay with 8 points. I don't want to spend a lot of money because it's obviously a very volatile stock. And I always try to keep things around a couple of bucks here on Options Guide TV if we're speculating on trades like this. So that's $2.28 or 200. We'll call it 230. Make the math simple. And this will be the official paper trade and in Palantir. We'll look at some others. We're going to look at something in Coinbase today also. But we have this position. I don't mind this trade at all. Palantir came up to a precipice. It didn't make it through. We got more downside. I think the path of least resistance. We're going to go out 9 days. We're going to do this bear put spread. You could do the 16th too. You could give it a few more days. I think I want to keep it here on Options Guide TV at 9 days. And just looking at the chart, this is all based off of the chart. Is the downside momentum continue? Do we fill? Actually, this long candle right here is another reason. But we're meandering around and just kind of hanging right there. I did not put any of the Palantir trades on. That's fair. That's more than fair. That was a risky trade to start with. I like that. Okay. Thumbs up to you, Anthony, for being smart enough not to do one of them. Let's look at the skew in Apple, because that's 100. Well, it's a little bit more expensive. $200 stock. I guess Walmart is around there. $100. Okay, so look at the skew in Walmart here. So if we got 78. Yeah, we still got some skew in that too. So you go down 5 points from 95 down to, or 97, we'll say, down to 92. I got about 4 points of skew. And it's not quite as big as in Palantir, but Interesting enough that Walmart is showing that. To me, this is showing nervousness in Walmart too, because of, well, they got their earnings coming up. Yeah, that's because of potential earnings, I guess. Let's look at the 9th. If we go to the short term, we only got, we still got a few, we're still going 3 points from here to the 1 standard deviation move out. There's just nervousness across the marketplace. That's a pretty big skew in implied volatility in Walmart across the board. All right, what was the other trade? So we did Palantir. I want to look at Coinbase today. And then I got a couple other trades. We still got Netflix on, so we need to review that. I want to look at the VIX trade. I'm a little bit annoyed with the VIX trade, honestly, because we've been right, and it's just not really paying us off as I would like it to. Okay, so Coinbase is going to announce on Thursday, and that is the main reason why I'm looking at it. We have the stock is trading at 200. Coinbase is an exchange that trades mainly crypto, but does other weird underlyings that a lot of exchanges don't want to trade. It's a very well run exchange. It does very well. As a matter of fact, I have bought in Coinbase as an alternative in times as an alternative to buying Bitcoin outright. I own a very little bit of Bitcoin, not a ton, and I don't plan on selling it anytime soon. And I've had it. I've been down on it. I've been up on it, and now I'm up. But bottom line is, Coinbase is an interesting alternative. It does very well. When cryptos do well, the company does well, even though it's a real company. You have assets. It has earnings. It's something that you can grasp and put a valuation on. So Coinbase is going to be announcing on Thursday. Let's go look at the chart. And once again, we have the fun scenario of a 0 DTE option in Coinbase. Right in here, we broke through the upside, strong movement up. It's just choppy. I don't think we're at a precipice as far as the 20-day to the 200-day. We're right below the 200-day moving average. When we crossed below the 200-day, kind of battled back, a little bit of upside, a lot of implied volatility. Right here looks like a level of resistance across the top, right around that 270 level. All right, we're going to try it. We're going to look at it. I was playing around with it a little bit before the show, going 2 days out. It's a little hard to get this thing done for a net credit. I wanted to go 5 points wide, but it was done for even. The expected move with 2 days remaining. Let's start there. We're going to buy this one. We're going to buy this one. I like that Coinbase is a $200 stock. I like the fact that they're announcing on a Thursday after the close. We're trading at 123% implied volatility. Looking right here on the at the money. The expected move, well, once again, we're at about 15 points. So we'll call that right around 215. That's give me a delta 20, right? So 1 standard deviation move is about 217. And so we're right between 212 and 215. You guys want to be bearish or bullish? And once again, I'm leaning. I want to do bullish if I could get it. If I could get a decent net credit, I'd rather lean to the bull side. And the only way that I can see to do there's the implied volatility. Notice the skew on the call side isn't. This should be dropping off. As you go further out of the money, you're still paying up for these option contracts, and it's screwing up my butterfly. I don't like that. Down here, this is normal skew, like 123 going to 130, and that makes sense on the put side, but it's not really making me that happy on the call side of things. That implied volatility is going up as we go out. And so it makes it, let's look at this one. But 2.5 points is tough, but you got 1 day. That's the thing. You got 1 day for it to live. So if it can land somewhere in the middle, we're going to be okay. buy this one, sell 2 of these. And you're only going to have 2.5 points of risk, which is nice. So you skip this and you buy this. Come on. Oh, too many legs. Buy, sell, skip that one, and buy this one. 22-cent net credit for, so we're probably going to want to do a few more of these. So you got $2.50 worth of risk. Yeah, that's not bad. That's not bad. 22 divided by 250. You're talking about 8%. So if you did, in this scenario, you did a 5 lot, you're doing pretty good on the total amount of risk, because we're only going 2.5 points wide, and we get it done for a 22-cent credit. So the expected move is somewhere around 215. That's about where you're at. Risk kicks in from 217.50 on up, and then you're going all the way up to 220. That's where your max risk would occur at. Now, I might want to let's look at one other alternative here. Let's send this to the what if calculator. I'm going to call this the paper trade, though. This will be the official paper trade. And we're mainly trying to capture that 8%. We're trying to, well, it's almost 9%, 8.8. That 9%, hoping that the market will go down. If it drifts higher, I don't expect to make that 250. That's such a small range that it could land in. But let's try a little bit different butterfly today. This will be fun. Let's go 5 points wide and double it up. We're going to do a ratio butterfly. So hold on to your hat. Let's see what this does. Let's see if we can go 5. And this should get a little bit better. We'll sell 2 of these. So instead of going 212, we're still in the May 9th expiration. We're going to sell 2 of these, and then we'll go another 5 points. Then we're going to sell 3 of these. So we're going to do 2 spreads, and then we're going to buy this. Now that's interesting. Oh, we got to buy 2 of them. Damn it. Yeah, that was too much. Now you're 40 cents. So you double it up. Yeah, and your width is, and you got $5 worth of risk. So I guess that makes sense. You didn't really do much to the trade. You now have $5 worth of risk to make 40 cents, as opposed to $2.50 worth of risk to make 22 cents, right? So it didn't really change things up. This is a little bit more interesting to me because it could land, on that 215 level. I think I'd rather do one of these than 2 of the others. Yeah, I think I would. All right, I'm going to send this to the what if calculator. So what do you think of this trade? Now, this is, it's a ratio butterfly, and you're selling 2 short spreads to pay for 1 long spread. And that's the way it's working out here. So 2 short spreads taking on risk here to pay for one of these. So one of these needs to have a margin requirement, which is going to be $5. Trying to get it done for a net credit of, well, I want to get that 40 cents. I don't really like this at all, so the market's moved against it. But that's where I would be at. And once again, look to put these things on Thursday before the close is when you really want to put this on. Now, I'll leave that. You guys want to give which one do you like better? We have out of all these years of doing live trade shows around earnings, we've done this before, but this isn't my go-to. I'd rather do the skip strike. But the way the Coinbase is set up with the way the skew is, I think I'd rather do this trade, the 1 by 3 by 2. Now, Netflix, long butterfly that we put on. Very interesting the way this trade is playing out. Send a ticket. We wanted to come up. We had this nice big round number at 1,200. I guess we can look at the Netflix chart real quick. NFLX. The news about the potential tariffs scared some people away, but the stock has just been chopped. got up to here, expected kind of a pullback just because it's just so strong and obviously overbought relative even to the 200-day moving average all the way down here at 847. But right now, it just looks good. We have until the 9th. We would love to slowly drift this way. If we hit the 1,200 level, we don't want to continue anymore. We don't want to get to the risk, so we close it out. 84 cents. Well, we put it on for 84 cents. I don't know why that's showing that. And you could take it off. So you could take the net credit off if you wanted to, but I don't know why you would. You have 2 full days and you don't have any earnings catalysts. You don't have anything. You obviously have trade war catalysts, which every stock does at this point in time, but you don't have any of the earnings catalysts. The stock held up well after the tariff as far as the movies are concerned. I think a lot of people just kind of paused and said there's something that's going to happen there. It's not going to be exactly how it was worded. So everybody's kind of looking for the next news headline as to what's going to happen. And I really like this trade right here. Really like that we put this one on. And we did it after earnings. Applied volatility was high. We did it after the run up. Okay. And then I'm getting a little long in the tooth. We also did a short VIX spread. And this one was a simple trade to put together. Send a ticket. Now, I always want to draw attention to my X profile at Brian Overby, at my name. And I have an article inside my profile called Decoding the VIX. So the VIX is a different beast to trade. I don't like the other volatility indexes, the VXX and all these other things that just have this nuance. I like the VIX options, but the VIX options are hard to understand. Okay. So the VIXs obviously came down. When we did it, the VIX was up around the 30 level. Oh, it was beyond 30, actually, when we put it together. The actual futures contract that we were trading, which is this May 21st expiration, was right around 30. But the VIX doesn't give up volatility very easy. The VIX of the VIX is the volatility of the options on the VIX. So we wanted to go below 30. We put it on, now I wrote it down here, the VIX. I think we put it on for double this. We put it on for like 60 cents, and now it's trading for 27 cents. So this is annoying to me, very annoying. But there's still a lot of potential news. We got the May 21st expiration. We got 14 days away. We could take it off for 60 cents. The actual market, and let's pop out here. I'm going to show you something. And I've shown you how to calculate the VIX a couple of times. But if you go to the Chicago Board Option Exchange, and these quotes aren't always there, but if you go in and you type in VIX, actually you can just Google or Chat GPT, and got to be a little sketchy there. VIX futures, and the CBOE does give you delayed quotes on the futures. So right now, a 15-minute delayed quote on the contract that we're trading says that the VIX is at 2360. And if we go back and look at our trade real quick, like at 2360, so that means that the 23 put and the 23 call should be fairly close, and they are. The call is 196 and the put is 1932. All right, so you take that, you subtract those two, and you're talking about 60 cents, and that puts that right about here. Actually, oh, there you go, 23.50. Now look at how close the prices are, right at the 23.50. I didn't know there was a 50-cent strike. So this is called put call parity. You would buy this, and you would sell this, and that's a synthetically long VIX index, actually. And you see it's 20 cents difference, a 20-cent net debit to the account. And this is, we're paying up for this one. So in this is, it's putting the price right around 23.60, very close to what the futures contract is saying. So we put this on when the VIX was when the actual VIX index was right up around 35, 36. The actual VIX index has came down and is now trading at 24.75. Well, that's interesting that it's up today. We're a little bit down on the market. We're flat. Okay. So, but it's interesting that we're trading up, but we have the Fed meeting. So I forget about that. We got the Fed meeting. So it's kind of holding its own there. But the fact that it's came down so much and the future's at this level and we just can't get out of our VIX trade. Well, looking a little better right now at 21 cents. If I could get it off for 10 cents and I could make that 50 cents on it, I would do the trade. And I would put in that good till cancel trade. Did anybody do the VIX trade that was out there? We've had this one on for quite some time, but we knew that. We just went out and basically targeted the normal monthly expiration, which is the green symbol versus the weekly. The weeklies are illiquid. So the next one that I would ever want to trade would be the June contract. And let me just do that dance again. I'm curious where the June contract is at without having to go through the chart. The June contract is also at 23 and July is 20. Everything's right around 23 going all the way out. So the uncertainty goes above and beyond, going all the way out to December so far as the VIX futures are concerned. Got out about a week ago for a gain. Yeah, without a doubt. Smart move, Anthony. I like that. The VIX, if you can take it off, you can take it off. If you could ever get it, did we do it for 50 or 60 cents? I had it written down, but I don't know where I wrote it down. All right, I think we're going to have to call it a day. I'm going long. I got another webinar that I have to do. We closed out. Anything else I got in the what if calculator? Coin. Nope, that's everything. All right, that's it for this edition of Options Guide TV. We'll be back on Friday, see how the coin trade did. I would look to set up the coin trade. I like the ratio butterfly. I would wait till closer to the close tomorrow to put that trade on. Don't mind that trade at all. I like that trade actually better than Palantir in this instance. We're doing it for a net credit, so you're neutral to bearish on the trade. We're getting a solid net credit for a $500 worth of risk, looking at about 40 cents. I guess you could maybe call it 37 or 38. So I like this long butterfly in coin. 1x3x2. Yep. And I'll put this up one last time and then we'll call it a day. Let me send that to Ticket. 33 cents. We're already making money on it if we did it. All right. We started at 40, so this is annoying. I would try to put it in at between 35 and 40 cents, and that would be my goal. All right. Thank you for showing, everybody. Thanks for tuning in. Please share with all your friends. Check us out inside hub.tradier.com. Thank Tradier for sponsoring this event. Check out all the great speakers that are in there. We're trying to grow this space, so please let everybody know about it. And we'll see you after Coinbase's earnings on Friday. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.